Good morning, students, or hello, students. Today we're gonna talk about money and finance. Basically, the origin of money, why we need money, the history of money, and the role of finance. What is that finance? We always talk about it. I will go quickly through the slides. You will have a copy of the slides. You have a copy of the video as well. And then if you have a question, always feel free to contact me. The outline of today, of this week class is what's the history of money, the role of money and key characteristic, medium exchange, medium versus method of exchange. People are confused between medium and method of exchange. Ledgers, payment system, money supply, financial institution, what type of risk we have, and the interconnection between finance and technology. Finance and technology, this is the critical for us. Why? Because innovation is critical for financial market, for any economy, for any country. So finance, if you want to be a good in finance, you have to understand what the potential innovation. And this class is about technology, blockchain technology. So we're going to talk about this stuff. This class is just an intro to talk about the blockchain technology. So chapter 1, the history and the role of money. So I will go fast through this slide so you can read it also. The word of money came from a Latin word called moneta. Maybe I have accent, and that means a coin. It means a coin, or in the French, monnaie. Maybe my accent is wrong also. There is also a word called uni, and according to William Webster, the meaning of the word money is something generally accepted as a medium of exchange, a measure of value, or a means of payment. The history of money. We have there are many long history, but there are 3 big steps: barter system, commodity money, and representative money. So the barter system, for example, I'm a farmer, I can give you tomato, you are a professor, you teach me finance. I have chicken, I can give you eggs, and if you're a bartender, you bar a barbershop, you cut my hair. So you exchange good for good, good for service, or service for good. Commodity money. So that's big. In Africa, you used to sell, they have a rare black stone in Africa. So if you have something very fancy, very limited, rare, so you can trade that for also goods and services. If you have that black stone, you can ask for 5 eggs and 3 tomatoes, for example, if somebody sells both. Step 3 is representative money. And so banks enter to the system and start doing something called commodity money, which is a deposit you can put in a bank. And this is, we call it representative money system. So when the banks came and they reinvent the role of money and the need of money, and now we have a credit card become to be another representative money. Paper money is started in 1661. Before that, we have coins and we have silver, but paper money became to be the first one. And then we move to the gold standard, which is every country has a reserve of gold, and that will be the wealth of the nation. By the way, the gold standard caused a lot of economic problems. For example, France was thinking, in order to be the richest and the strongest country in the world, I should have the most gold in the world. So what they did, they said, no more import, because when you import products, you have to give up golds. We're going to do only export. When we export, we get gold. As a result, the French economy became to be weak. And the result is they cannot export their products without a raw material that they need to import that. So, and that's the reason for the gold standard hurt the French economy. So it's there. fiat money and post-World War II. So post-World War II, it's important to understand what happened. It was a war between Germany and a few countries on one side, Russia in the east, France and the UK in the west. But the war over when all the economies were destroyed. Like London was down, Paris was down, Berlin was down, Moscow was down, Stalingrad was down. So all the countries after the war is over, yes, the Russian army and the American army was in Germany, but the cities were destroyed in Germany, Russia, UK, and France. So as a result, they have a Marshall project, which is US building machine and send it to Europe to rebuild their infrastructure and to rebuild their industry. And then these countries didn't have money, so they give loans to these countries, and then they use a dollar for these loans for the exchange of the machines that the US was given. So that post-World War II was a mark in the history of money, and the dollar dominated the world because of that. And then we created something what's called the International Money Fund, IMF. They have a small role now. It can have a bigger role. So, and then we have a fiat money. Every country became to have a currency in 1971. That's important. President Nixon ended up the gold standard and the reserve for gold. And he said, use a dollar as a medium of exchange, and countries don't need to store gold in America. Just buy American bonds, American dollar bonds, and then you should be fine. So before that, countries, in order to have some liquidity, they need to give dollars to the US. And by the way, 1/4 of the store of gold is in New York. And 1 year I took my students there. We saw that. It's in the basement. You have to go through security. It's interesting. In 1971, Nixon said you didn't need to reserve gold. You can buy an American bond, and that will be a reserve for you, equal to gold. And that's what makes the US to be dominating the world economy, help the US to dominate the world economy. The IMF, these countries start to work with the IMF to support their currency and things like that. The IMF has a projects to support countries' currencies, but you have to adhere to their policy. Their policy sometimes hurting the economy in the short term, but in the long term, it helping the economy. How is that? For example, the IMF asked not to have subsidies in the countries, and we see that in Egypt and Egypt and Lebanon. They ask them, if you want to have a loan from us, you have to cancel subsidies and you make your currency open for supply and demand, not to be controlled by the Federal Reserve. But by not giving subsidies, you hurt the poor people. But in the long run, the IMF thinks, I didn't know, but the IMF believed that it's good for the economies to have to liberate the currency. Now, the role of money. The role of money is a store of value and unit of account. For example, I work at University of Colorado. I get monthly salary. So they say your salary, for example, X amount of dollars. Okay, so the dollars help me to know how much I have income, and then I would know how much I can spend money. So it unit for account and store of value. If I don't need to spend the money, it sits in the bank, and I know later on if I want to buy a car, buy a house, education, I know how much value I have there, and if I can afford that. Now, the key characteristic of money are that it's durable. Whether paper or coin money, it's durable and portable. You can move it one place to the other. Divisible, you can save $15.30. And uniform, that means all Americans use it. If you live in a country, one currency. Now, medium of exchange versus method of exchange, and how that's important for crypto. It's important here. Before, medium of exchange is the same like method of exchange. Like I go to the store, I buy grocery, cost me $100, I give him $100. The medium of exchange is $1. The method of exchange is a cash, also $1. Now, in these days, The medium of exchange is a dollar. The method of exchange is different. Could be a credit card, could be cash, could be a check, could be many things. So the medium and method of exchange become to be different between one and the others. The medium of exchange is a dollar, but the method of exchange could be a credit card, could be a check, and cash, and other things. With the crypto, you didn't have this issue. With the crypto, with the decentralized finance, that means peer-to-peer. With the crypto, you didn't have this problem. The medium of exchange with the crypto is also the medium of exchange. The medium of exchange, for example, Bitcoin, the method of exchange is also Bitcoin peer-to-peer. Like if you are on a blockchain, and you didn't know what's a blockchain, but if we are in the same system, and I get a service from you, you said it's gonna cost you 2 Bitcoin. So the medium of exchange is Bitcoin. The method of exchange also Bitcoin, because I'm gonna wire to you peer-to-peer, P2P, the crypto. Now PayPal has something called Venmo. Venmo is a type of blockchain. That's the reason I like this class, because it's about technology. So PayPal is the most advanced, now Visa catching up, most advanced. They created a blockchain called Venmo, and that blockchain does peer-to-peer. If you and I are on Venmo, we can make a transaction. I send you money, you send me money for service or other things. So again, decentralized finance is peer-to-peer. When I say decentralized, that means not centralized through Visa card, but peer-to-peer. We're going to talk about this a lot in the rest of the semester. But decentralized finance, when we say decentralized medium of exchange, that means peer-to-peer. Ledgers and payment system. A financial ledger is the backbone. When you work, like today, you go buy breakfast, lunch, you sell something, you get something in your bank out, all of that, it's reported in the ledger. So ledger is the backbone of any corporation and financial institution. A ledger has 3 main principles. The most common ledger utilizes what is known as double entry, which is accounting system. When I give you cash, I get something, so double entry. It means I gave up some cash, I got some service. And here is example. A company, for example, ABC buys material for $1,000. A debit of $1,000 is recorded to the cash account, and a credit of $1,000 is recorded to the inventory account. Balance is key principle driven by this system. And here we talk about ledger and means of payment system. So the ledger help us to report all the financial transaction, monetary value, and there is ATM machine, SWIFT machine. SWIFT, if you do across countries, there's a ledger there. The ATM, if you do it you on a bank, there's a ledger there. So everywhere is ledger. Now we're gonna go to US money supply, and that's important. Before, the money supply was by the king, and then we have a democracy, president or government. Now the money supply is by the Federal Reserve. Federal Reserve is a part of the government, but independent from the government. That means the president of the United States cannot tell how much to print dollar. It's a Federal Reserve decision. Now, it's important to understand here. The government, in this case, President Biden today, in these days, can increase the purchase of the government or the government size by selling bonds. I want to build highways. Here are the bonds, and I get cash, $1 trillion. And then I give that to contractors to build the highways and things, bridges. But the government give bonds, doesn't give cash to the economy. So you sell your bonds and you get some debt. So you didn't print money, but you can print bonds. That's important. The actual printing of money is the Federal Reserve. And when the Federal Reserve want to increase the money supply, what the Federal Reserve does, go to the market and buy the bonds. When the Federal Reserve buy the bonds, that means he has to give money to somebody, and that somebody will increase the money supply. When the Federal Reserve want to take the money from the economy, we start selling bonds, like as of these days, we are in end of the 2022. So you sell the bonds, you get money from when you sell the bond, you get money. You take this money and you lower the money supply. The Federal Reserve has two goals: low unemployment between 3 to 4.5%, low inflation between 2 and 2.5. You can, so what you want to have, you don't want to have inflation, but if you put a lot of money, then inflation will go up. But when you put a lot of money, there is demand in the market, so people have more money, they go consume more, so that lower the unemployment, because if people have money, start buying, business hire people. So these are working against each other. When you put more money, more inflation, but low unemployment. If you take money from the economy, like these days, unemployment going up, but inflation going down. A comparison between money supply between Federal Reserve and cryptocurrency, and that's a crux of the innovation of crypto. The money supply is determined by the Federal Reserve and the FOMC. In the cryptocurrency, it's a self-governed technology. So the technology determines the money supply based on the transaction that they have. The receiver of the money, banks and Federal Reserve government. If the Federal Reserve print money, they give it to banks. In the cryptocurrency, to the miners and the people who do the verification for the transaction. Financial inclusion, there is no financial inclusion in our system because money going to the bank and less to the common people. In the cryptocurrency, actually, it goes to others. Goal of the supply, lower inflation and unemployment. Here, the goal of the supply in the cryptocurrency, rewarding those who verify the transaction. So you work hard, you'll be rewarded. But here is the money supply determined by inflation and unemployment. Uncertainty is high. In the Federal Reserve System, we have a high uncertainty. We don't know what's going to be the interest rate next month or next year. We don't know what's going to be the money supply. In a cryptocurrency, you didn't have a lot of uncertainty because technology determine the supply, and from the technology, the numbers now, then you're going to know what's going to be the supply. So less uncertainty. Store of value is risky. In the cryptocurrency, is very risky because we see a high value for crypto move a lot, and that's the reason more volatility in crypto. We're going to talk about this later. But the high volatility in crypto because crypto is owned by only retail investors, not institutional investors. So we need institutional investors to be involved. Then the market will be by money players. Then the volatility will go down. Financial stability. We have money crisis. I just want to name 3 ones. The dot-com bubble, 2000, 2001. In the great 2007 and 8. The collapse of the banks. In 2020, when COVID hits, we have a 40%, the market went down. And now we are in 2022 with this war in Ukraine, and we have a lot of uncertainty. Here in the crypto, we didn't have enough history to see. We didn't have a crisis. We have currently, late 2022, the FTX exchange. It's an exchange problem, not a crypto problem, but it's a little bit hurt crypto. I want to talk a little bit about Bitcoin as a key crypto, as a self-governed money supply versus the monetary policy. Bitcoin self-governed money supply or monetary policy as follows. Bitcoin creation originally 50 Bitcoin per block. And we're going to explain what is that a block. So Bitcoin does 50 Bitcoin per block. That's supply of Bitcoin. Reward halves every 210 blocks. And market-based transaction fee mechanism also provided for Bitcoin core. So Bitcoin can be a money supply, also can be a money fees. Final thing about Bitcoin currency. Currently, we have a 17.3 million Bitcoin, and we cap it at 21 million Bitcoin 2040. In 2040, the money supply of Bitcoin will be 21 million. Here's Ethereum's on money supply. Ether, 3 Ether per block, therefore inflation at 7.4. Fresh proposal to decline, it's 11 to 18. I will explain this later on. Fees pays, that's a method of paying fees. I'll explain that later, but that's a way of Ethereum money supply. Here are some histories of images of the history money and coins. There's a back in the history they have a wood, they call it sticks, as a way of doing money exchange. There are some notes also, and here are the questions for this chapter. You can read them, and since this is the first week, I don't like long answers. The answer could be one sentence, could be one line, could be two lines, could be one paragraph, but short and sweet. I don't want a lot of answers, just short and sweet, one line and done. Now we're gonna go to the role of finance. The role of finance is simple, two things. Is pricing money and risk. One of the key roles of financial market is to facilitate and moving, allocating pricing of asset. The word facilitate is, or financial facilitation means that the financial market provides a place where buyers and sellers can meet. The place they can meet is a physical place or virtual via the net. So for example, the CME have a commodity, like if you want to buy cattle, wheat, corn, you can do that via the net. You didn't have to be in Chicago to buy the wheat and put them in a truck. You can do the transaction and something indirectly will go and deliver for you. This financial market also can be in place. Like if you want to sell your car, you go to a dealer. So that could be facilitated. So the place where the seller and buyer meet, it's critical. Pricing and risk. Each asset should have a listed price based on its market value, and it's traded on. The asset can be a stock, equity, bond, wheat, anything. There are three types of risk. There is the risk of crisis and instability, like these days, war in Ukraine example, inflation, another example. The risk associated with fiat money instability, when the Federal Reserve start taking money from the market, putting money in the market. And the risk of financial inclusion, where market factors money may enhance the wealthy versus the poor. Now, when you raise the interest rate, you increase wealth inequality because the rich people are the saver. So their saving rate will go up. The poor people are the loaners who take loans. So their cost of debt increases. So when you raise the rate, there is more inequality and there's a problem with financial inclusion. Financial institution, now we're going to talk about financial institution. There are many ones. The biggest one is the Federal Reserve, and you can read more here. And then you go to commercial banks, and then you're going to go to other financial institutions like a Stifel, Robinhood, which is a brokerage accounts, Investors, another one. And then you have a credit card companies like Visa, MasterCard, they give you credit. So these are a financial institution. And then we were talking about how the larger tender fiat currency is represented by central bank notes and commercial bank deposit, and depends on the system of ledgers. The difference between money and gold and silver is money supply doesn't depend on the demand supply factors. Like if you didn't do a lot of mining of gold, then you have a problem with the supply of gold. And then we talk about the system of ledgers, how the bank operates, and you can see it here. And then I'm going to talk about a concept, time is money. The reason time is worth money is because it's not a tradable value. For example, you cannot say you can have two choices: play games or work. So tradable value, if the game's worth $100 of your wealth and the work $90, then you're gonna play games. So in order to your time to have a value, is you have to estimate the opportunity cost of your time. And here we explain what is that: unit of account, medium of exchange, and transportable store of value. Now we're going to talk about how money maintains its value. We're almost done with the lecture. It's just overview of finance and money. Money can keep its value if it's limited. The supply, stable limit of supply. The more you increase the money supply, the more it loses its value. That's number one. Number two is the market that facilitate movement of money. And that's where crypto become to be enter this system, is adding value by facilitating between buyer and seller, or two people who want to transfer money. Now we're going to go to finance and technology, the last topic. And then technology help to scalability and efficiency, and technology help in security and privacy. So finance need technology to help them with scalability and efficiency. Scalability, like if you have 1,000 transactions every second, in the future, maybe you need a 10,000 transaction every second. So you need the technology to support the scalability. Security and privacy, cyber security and other things. Also, you want a technology to support your privacy. Nobody knows your accounts, cannot enter your accounts, cyber security attack. These are the key roles for technology to support finance. The third one is intertradable, in particular, how operable is the network, and to what extent can we trust it. The fourth issue that I'm going to talk about it is public policy and legal structure. So the issue will be dealt with later. We're going to talk about it later as Congress finds the path to regulate cryptocurrency. The policy we'll have. We're going to talk about this, how the regulation will help the crypto to do the public policy and legal structure. So we're going to explain that, how the government can help us use the crypto to facilitate transaction between people. As of now, there is no regulation, and we're going to have half a class about that. But as of now, there is no regulation, and that causes a problem to do a transaction between two institutions. I know the state of Colorado, you can pay your taxes with the crypto. I heard about that. I read an article. I'm not sure if it's still working. And here is the list of technology of our generation: AI, artificial intelligence, machine learning, and here is explanation. A blockchain, like a storage cloud technology, is a blockchain. Application for programming interference API, and chatbots. So there are several technologies of our time. Now, AI and ML, it will be a separate class, but definitely our class will do the blockchain, that YouTube use it, Google use it, Amazon use it, a lot of companies using that. And here's example of AI and some pictures I collected for you. Chapter 2, homework questions. What is the role of finance? What type of risk? We talked about all of that. First week is done, lecture. That's it, pretty much. 2 points: the role of finance, medium and method of exchange. The role of money and the history of money, medium of exchange and method of exchange. And then the role of finance, which is to facilitate money transaction, and why we need technology for scalability and for privacy and security. So these are the questions. Please answer one. Like, what's the role of finance? Could be a 2-3 lines. What the type of risk we have? Couple lines. I don't like long paragraphs. Big, short and sweet. So basically, all of the 6 questions can be in 1.5 pages. The question with the answer, 1.5 pages. And this is an intro to the first week class about what's of money, history of money, finance and role of finance, and the technology of our days. Thank you so much. And I hope you enjoy the first week intro to the class. Thank you.